One of the most common questions people face on their financial journey is whether to prioritize saving or investing to build wealth. While saving offers security, it often provides limited growth. Investing, on the other hand, has the potential for much higher returns, but it also carries risk. So, what should we do? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. The power of investing. Imagine planting a seed with the expectation that it will grow into a towering tree over time. That's essentially what investing is all about. Putting your money into something today with the hope that it will grow in the future. The goal is to make your money work for you, so you end up with more than what you started with. When you buy stocks, for instance, you're purchasing a small piece of the company. If that company thrives and profits, the value of your stock can increase, allowing you to sell it for more than you paid. Other investment avenues include real estate, bonds, or even starting your own business, anything that has the potential to generate more money over time. Investing is a game changer when it comes to building wealth over the long term. While saving is crucial for covering short-term expenses and emergencies, investing is what truly propels your financial growth. By putting your money into assets like stocks, bonds, or real estate, you're giving yourself the chance to earn much higher returns than you would from a regular savings account. Consider this. Over the long run, the stock market has historically provided an average annual return of about 7 to 10%. The Bank of England base rate, which then impacts the rates that your banks will give you as a saver, has been pretty pitiful over the last 10 years, only recently surpassing the 1% mark. Right now, as I make this video, one of the best rates you can get is 5.17% on uninvested cash or savings within a cash ISA, but that hasn't been the case over the past 10 years, as you can clearly see from the graph. And talking of Trading 212, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you opened up a new account recently or planning to open an account, then here it is, DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in, and receive fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. So if you invest in stocks or a diversified portfolio of assets, your money has the potential to grow exponentially faster. While maintaining a savings cushion for emergencies is important, the real wealth building happens when you invest and let your money grow. If you're aiming to grow your wealth, it's essential to start thinking long-term and begin investing. The earlier you start, the better, because time is one of the most critical factors in investing. Even if you start small, consistency and time can lead to substantial rewards in the future. The purpose of saving. Now let's shift gears a little and talk about saving. Saving involves setting aside a portion of your income for future use, rather than spending it all now. It's a way to build up funds over time that can be used for emergencies, short-term goals, or significant purchases. Unlike investing, which aims to grow your money, saving focuses on preserving it. The goal is to have enough readily available cash to meet your immediate financial needs without relying on debt. One of the biggest reasons people save is for the short-term security. Having savings gives you the freedom to cover unexpected expenses or achieve short-term goals without financial stress. Think about life's big events like taking a holiday, buying a new gadget, or dealing with urgent car repairs. If you have a savings fund, you don't have to resort to high-interest debt or scramble to find the money by selling stocks at a bad time. For example, imagine you've set aside 3 to 6 months' worth of living expenses in a savings account. That's your financial cushion. If something unexpected happens, like a job loss or unexpected emergency, you have that safety net to rely on. You don't need to panic or worry about taking on debt because you already have the funds ready to go. That kind of financial stability can make all the difference in tough situations. When it comes to where to keep your saved money, high-interest savings accounts are a solid option. While the returns aren't as high as what you might get from investing, these accounts offer safety and liquidity. Your money is protected, often insured by government programs up to a certain amount, and you can access it quickly when you need it. Unlike investments that can fluctuate in value, yes, that does mean they might be lower than the amount you put in for some period of time. Savings accounts keep your money secure and readily available. So, for your short-term needs and emergency funds, savings accounts are the way to go. They provide both liquidity, so you can access your money anytime, and security. Your money is safe and protected. When to save versus when to invest. When to save. Let's start with when saving is the right choice. If you need access to your money within the next 1 to 2 years, saving is your best option. This includes goals like building an emergency fund, saving for a down payment on a house, or preparing for other planned expenses. The main goal with saving is ensuring your money is easily accessible, safe, and won't fluctuate in value. Suppose you're planning to buy a car within the next year. You wouldn't want to invest that money in the stock market where it could go up or down. By putting the money in a savings account, you're ensuring that it stays safe and you can access it quickly when you're ready to make the purchase. When to invest. Now let's talk about when investing is the right choice. If you're saving for long-term goals, like retirement, your children's education, or achieving financial independence, investing becomes the key to growing your wealth. The advantage of investing is that you don't need the money for many years, so you can afford to take on some risk in exchange for potentially higher returns. Let's say you're planning for retirement, which could be 20 or 30 years down the road. You could choose to put your money in a savings account, but the returns would be minimal and your purchasing power might decrease due to inflation. Instead, by investing in stocks, bonds, or real estate, you give your money the chance to grow and compound over the years, helping you build substantial wealth for the future. The concept of compound interest is powerful here. The earlier you start investing, the more time your money has to grow exponentially. Those early years of growth can make a massive difference by the time you retire. According to data from JP Morgan, a diversified stock portfolio has historically outperformed savings accounts over the long term, delivering higher returns despite short-term market volatility. Finding the right balance between saving and investing. One of the keys to successful wealth building is finding the right balance between saving and investing. It's not about choosing one over the other, but ensuring that both play a role in your financial strategy. On one hand, you need enough savings to cover your short-term goals and emergencies, and on the other hand, you need to invest for the long term so your wealth can grow. Both are essential and they each serve a unique purpose. This balance is crucial because focusing too much on saving might limit your wealth building potential, as your money isn't growing as quickly as it could through investments. Conversely, focusing too much on investing without sufficient savings could leave you vulnerable when unexpected expenses arise. And this comes into play if you're likely to fill your ISA allowance for the year too. As you only have £20,000 across each type of ISA, that means you have to make a trade-off where you have to decide what to fill it with. I think that it's almost certainly going to be better to use your ISA allowance for stocks and shares rather than cash, if you're in the accumulation phase, but it's a personal decision you have to make for yourself based on your own situation, of course. Conclusion. In the journey to grow your wealth, both saving and investing play pivotal roles, but they serve different purposes. Saving provides short-term security and peace of mind, ensuring you're prepared for emergencies and immediate financial needs. Investing, on the other hand, is the engine that drives long-term financial growth, allowing you to build wealth over time through the power of compound interest. By building a solid financial foundation, with healthy savings cushion and leveraging investments to grow your wealth, you're setting yourself up for financial success. Start early, stay consistent, and find the right balance between saving and investing to achieve your financial goals. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching and I hope to see you on the next video. See you!